Hi everyone, my name is Simon Mishevich from Optimize Accountants, and the Spring Budget 2024, the overview of tax legislation rates. And this is 2.7 of their report, which talks about the abolition of the Furnished Holiday Lettings FHL tax regime. What does this really mean to you as a landlord, especially if you're doing furnished holiday lets? Well, if you first of all want to get some good free tax calculators, you can do so by using that QR code on the right hand side. It covers things like stamp duty, land tax, capital gains tax, income tax, etc. Okay, so as announced at the Spring Budget 2024, the government will abolish the Furnished Holiday Lettings tax regime, eliminating the tax advantage for landlords who let out short-term furnished holiday properties over those who let out residential properties for longer-term tenants. This will take effect from April 2025. Please let's really focus on a particular aspect of what they've just said here. And it says here, eliminating the tax advantage for landlords who let out short-term furnished holiday lets over those let out residential properties for long-term tenants. So you're now putting one against the other, are you? Or is it just a different strategy that people want to follow? They're not enemies. So why write that? That's just total garbage. But anyway, so loss of tax relief. You can tell that I've lost faith with the Conservative Party, and I can't wait for Labour to get in, if I'm totally honest. As a Conservative Party member, voter, not definitely member, a voter, I still want the Labour Party to get in and get rid of the riffraff that we're seeing in the Conservative Party. Absolute jokers. Okay, so loss of tax relief for furnished holiday lets. What have we lost here? So first of all is the ability to offset 100% of the mortgage interest. So we'll talk about that as an example. So the mortgage section 24 mortgage interest relief cap, which prevents landlords from offsetting the mortgage interest costs, was exempt for furnished holiday lets. Now it's not. So there's a big tax impact coming your way, and we'll cover those details shortly. Claim capital allowances. Now, if you've got a furnished holiday let property and you do it up, you've got some furniture in there, you've got you put in some more kitchens, bathrooms, suites and so on like that, you could claim capital allowances on those items that you can't see to get some sort of tax relief. At the end of the day, you're investing some good money there, but you are not going to be allowed to do that anymore. CGT rollover relief. Where if you sold a furnished holiday let to buy another one, because you're expanding your business, so you get rid of some smaller stock to buy a bigger furnished holiday let, you used to be able to get some tax relief from doing that. Now, you could do that with businesses sometimes. You've got entrepreneurs relief, business asset disposal relief. And you could argue that this furnished holiday lets, vacation homes, etc. was a business. And this tax relief was pretty fair, in my opinion. But now that's been scrapped, and it's really putting furnished holiday let in the same bucket as residential property, so there's no relief on selling it when you're buying another one. If you need some tax advice, feel free to use that QR code just appearing on your screen. Okay, so let's talk about the income tax impact on basic rate taxpayers with this change. Is there really much of a change? Well, let's cover this in detail. You've got the old FHL rates, so the year 24, and going forwards, new FHL rates in the year 2025. So rent in both examples, £50,000. Mortgage interest, both examples, £20,000. Profit in each example, £30,000. The tax is £6,000 on both examples. Why? If there's going to be this huge change, is it such a big issue if you're a basic rate taxpayer? Well, actually, not really. Section 24 mortgage interest relief cap doesn't really affect basic rate taxpayers. It affects high rate taxpayers. Why? Because you get 20% tax relief on the mortgage interest costs. So that's no different really if you recalculate the profit, either taking the mortgage interest costs in or out, you still get 20% tax relief. So basic rate taxpayers, this doesn't affect you whatsoever. High rate taxpayers though, so one earning more than £50,000 as an example, will have a rental income of £50,000, mortgage interest cost of £20,000, profit of £30,000. Now the tax here is £12,000. Obviously, if you're a high basic rate taxpayer, it's £6,000. High rate taxpayer, you pay 40% tax, therefore you're paying £12,000. But the new FHL rules means that you get this £16,000 tax. And that's moving up from 12 to 16,000 because you're not allowed to get the mortgage interest cost. Now, you get 40% tax on the profits you make, but you get the 20% tax relief on the mortgage interest cost. So you have to do some calculations, but that's how you get to the 16,000. Now, those are that thinking, well, I'm a basic rate taxpayer, that's okay, isn't it? Well, actually, no, because by adding back the mortgage interest costs means that you could go from a basic rate taxpayer to a high rate taxpayer very, very quickly. So now you could be in this bucket, not on the previous slide that I talked through. So you do have to be careful with if you feel that it's not going to affect you. Actually, it can. What can you do to mitigate the tax impact? If you're looking for some property investment advisory services, there's your code on the right hand side, and I can help you with that. So first thing you could do is, of course, is just increase nightly rates. Why do you think rents are going up? Because landlords are passing on the tax increases from the government and putting it onto the tenants. So really, the governments are kicking tenants more than the landlords. So go figure. And then you've got move to a limited company. You can move your property to a limited company. The issue there you have now is you've got this impact of stamp duty land tax, moving it to a property company, the 3% SDLT high rate, and capital gains tax by selling the property. You could convert it back to a HMO or a single let. You may have thought, well, I transferred my properties to a furnished holiday let, has better nightly income, but I get a better tax saving, so therefore that's what I've done. But now you may think, well, actually, is it worth the hassle? If I'm not getting the mortgage interest tax relief at the right amount, 40% as a high rate taxpayer, but at 20% instead, you may be losing money. So you need to now rebase your profits, see if it's worth it. You may choose to go back to a HMO. You may choose to even go to a buy-to-let or even keep it empty. I know a lot of people that do keep rent properties empty. Keep it as a second home. And then, hey, that's it. Now, we haven't increased housing stock at all, have we, the government party? You can tell how cynical I am with the Conservatives right now. You can sell the asset if it's poor performing. So now is a good time to look at your property portfolio and say, well, how much profit do I get? How much return on investment do I get from these assets? And then ditch the ones that do not give me the best return on investment. Use the sales proceeds to pay off my mortgages, which right now the interest rates are incredibly high.